In many ways, ETFs, or exchange-traded funds, are an ideal investment, combining the simplicity, transparency, and low cost of indexing with the same ability to trade as individual stocks. They even have a neat little tax bonus that can keep your IRS bill down. You generally, though not always, can avoid paying tax on any capital gains until you sell. There's no doubt that ETFs can help investors with their retirement planning or just enhance their basic financial security. But the implosion of ETFs also has a potential downside. Namely, many of the new ETFs are complicated, risky, and could entice investors into strategies that may not be conducive to their long-term financial health. So, what should you do to assure that you're getting the most out of the benefits that ETFs have to offer while avoiding the pitfalls? Here are 3 suggestions. First, stick to ETFs that invest in broad-based indexes. ETFs make great low-cost building blocks for a broadly diversified portfolio. For example, by investing in a total U.S. stock market ETF, you can get the entire U.S. equity market in one shot at an annual cost of under 0.1%. Add a total U.S. bond market ETF and a broad international ETF, which you can get for as little as 0.12 and 0.13% respectively, and with just 3 ETFs, you've got a totally diversified portfolio at a very reasonable cost. I think most people will be fine just leaving it at that. But if you want to round out your portfolio to include exposure to, say, real estate, commodities, precious metals, etc., you can easily find ETFs that invest in these and other areas. You'll find most, if not all, of the ETFs you need to create a diversified portfolio by checking out the ETFs listed on our Money 70 roster of best funds. If you feel the need for more choices, you can check out Morningstar's ETF Screener tool. The second thing you want to do is avoid gimmicky ETFs, or ones that specialize in very narrow niches. For example, one type of ETF, known as inverse ETFs, effectively let you short or bet against the market or a segment of it. Another type, known as leveraged ETFs, allow you to try to multiply the effect of market movements, say getting twice the market's return when the market goes up or down. But because the way these funds calculate their gains, it's possible to lose money even if you guess right about the market's direction. That's why the Securities and Exchange Commission last year issued a special warning about these types of ETFs. Finally, my third suggestion is that you skip the ETF trading game. Some advisors note that you can use ETFs to easily move in and out of various market sectors, say getting out of energy stocks when you think they're ready to slide and jumping into healthcare or retail. This strategy goes by the name sector rotation. Well, while it would be nice if investors were prescient enough to capitalize on such calls, the record for doing so is spotty at best, and poor timing can result in big losses. To sum up, I suggest you leave the market timing guessing game to more optimistic, if unrealistic, investors, and also avoid those more complicated and riskier ETFs that can get you in trouble. Instead, concentrate on using ETFs to build a low-cost, tax-efficient, diversified portfolio, either with ETFs alone or in combination with mutual funds and other securities. Do that, and you know you'll be getting the most out of the advantages that ETFs have to offer.